thank you all for taking the time to join us today. As I mentioned, we're going to be doing a webinar about the social housing opportunity in the UK. We're joined today by Reese, who's a managing partner for Global Residential. Welcome, Reese.
Hi.
And we're also joined by Nathan, who's one of the founders of Yield Investing. So welcome and good morning to you, Nathan. I understand you're in the UK.
I am, yeah. Morning, guys. I'm in nice and rainy Leeds. It's good fun. But yeah, thank you for letting me come on. Look forward to answering questions.
Excellent. Well, look, I'm going to hand over to the two guys to the presentation. It should take 20, 30 minutes. What I would encourage you to do, if you have any questions, please type them in the Q&A box, which is at the bottom of your screen, and we'll address those at the end. But I'd encourage you to type them as the thought comes in and as a question comes in, get it typed in the box. We will address those all at the end. So for now, I'm going to hand over to Reese and Nathan, and we'll catch up again at the end for a Q&A session. Over to you guys.
Thank you, Matt. So I'll probably start off just by introducing myself. We've got Nathan, fortunately, who at the end of this presentation, we can take questions and answers because he is boots on the ground and is an expert in this field. So Global Residential, as Matt mentioned, I'm one of the managing partners. I'm based here in Dubai, but Global Residential, we look to identify the best in class in terms of UK property investments. Yield investing is a concept built around social housing, and today I'll explain exactly what that means and what is available for clients. But in terms of generating income, this for us is most certainly one of the best products that we've looked at as a concept, and hopefully you'll agree just by how this has been structured for clients. So if I can move my slide. So social housing, what is social housing? Social housing is a highly regulated sector where operators are required to be registered with local housing associations. All assets are then managed by the provider on fixed lease terms. This essentially will generate an income from day one. So a quick overview on Yield Invest. Rental yields would range from anywhere between 5 to 10%. The investment size is from 50 up to 10 million pounds. Now, with the relationship that Nathan and Yield Invest have formed through their network in the UK, we have relationships with over 10 housing providers. And to date, we've sourced over 2,000 social homes and rehomed over 1,000 people. Now, rents are issued on a fixed basis on either 5, 10, 15 or 25 years, depending on whether the investment is a standalone house or if that's a block of self-contained flats. Now, typically, if we are looking at the fixed 5-year rental assurance, we would typically expect anywhere between 6 to 8% net yield. Now, that would typically be a standalone house. If we are looking at a block of self-contained flats, that's when your yield would be slightly compressed from about 5 to about 5.5%. Obviously, the block of self-contained flats would be on the higher end of the spectrum, starting from about £1 million up to about £10 million. Essentially, we're looking to provide significant income with exceptionally low risk, regardless of the performing economy. So just to cover off the demand for social housing, there are currently 1.6 million people on the waiting list, which is 500,000 more than the recorded 1.16 by the National Housing Federation. The National Housing Federation have said that some families have been waiting more than 2 decades to get social housing, and that's only set to increase off the back of the pandemic. Now, in terms of supply that's been brought to the market, last year there were only 6,338 new social houses that were brought to the market, and that's a decline of 84% since 2010. Now, typically, this isn't a retail product, and in terms of who has historically been buying into social housing, it's typically been institutional or an institutional product. In 2017, Blackstone acquired Sage, which is a provider or a housing provider. And again, to give you a bit of kind of understanding on Blackstone, they've got just over £649 billion of money or assets under management. Goldman Sachs have entered into the market, and they've lent Places for People, which again is another housing provider, a £50 million loan. Again, this is simply because of the security that the social housing element does bring. And then finally, Schroders, they've recently closed on a £192 million fund in order to acquire social housing for their clients. We most certainly see this being a growing opportunity. In the UK, demand for social housing, the requirement is just over 145,000 houses every year. And that is roughly about a £12.8 billion market. In 2016, there was virtually zero of private equity that entered into the market. And if we look at 2019, it was just below £3 billion. So again, private equity is entering into the social housing space. So again, essentially, we are offering what is typically an institutional investment available for retail clients. Again, just to give an overview on exactly what yield investing offers, it will offer assured rent throughout the whole period of the contract. There's no tenant damage or maintenance cover that would be required. Now, because you are in agreement with the housing provider, there is no lettings and management fee. So your net position will be your net income. Now, the beauty of social housing contracts for investors are that there's no void periods. Essentially, the government is your tenant. Every home, and what Nathan can cover off shortly, is that every house that a client will purchase has been newly refurbished, and every single contract will have a minimum of a 5-year lease with no break clause. Because they are freehold houses, there is no ground rent or service charge. So again, looking at the net position, what we are able to secure on the agreement will be your net position. And then lastly, it is a truly ethical investment product. Sorry, just going on to the next slide. So as an example, this was a property that we recently sold. It was a 3-bedroom apartment in Bradford. The purchase price was £98,000, and that generated a 7.3% net return. This was on, again, a 5-year rent contract, and that would generate £7,200 of annual income. Just to give a quick overview, and I will then hand over to Nathan, this is an example of the portfolio of apartments and houses that we have on offer. So you can see the range starting from £62,000 up to just over £200,000. Again, showing you exactly when the start date of the tenancy agreement was signed. And to the right, you will see the actual housing provider. So it's not one provider that we typically work with. Depending on locations and where we bought that house would depend on the provider secured. So I am going to pass over to Nathan, just because hopefully that should give a brief insight on social housing, but I think it's important, because we have Nathan today, just to go into a bit more detail on the questions and answers, because I can assume it's quite a new concept for a lot of clients that are on the webinar. So Nathan, in terms of your experience in the UK social housing sector, can you just give us a bit of background on your track record and what you've delivered?
Absolutely. Yeah, so I've been working within social housing for about 6 years totally. That goes through providing well over about 1,500, 2,000 units towards social housing. We're working with multiple providers across mainly the north of England. Being the developer on the ground, we go through the whole process of sourcing and developing, obviously arranging the lease, and then either holding the property or selling it on. So I'm very well experienced in actually doing the actual on the ground, finding the property. We have teams now that are able to do that. We have a large construction company that are able to go out and obviously build to the provider standards. Over the past 6 years, we've been able to really drill down the relationships and then have a very strong relationship with multiple providers now that are able to give that different lease length and different contracts in different areas, and get a really good understanding of how that works and how we can obviously benefit that with our investors. So track record, we've done a lot of properties. Mainly it's been houses and individual properties that we've rented to either different providers in those different areas. Different providers have different criteria, but most properties are very similar. Social housing is a large market sector that is quite undertapped in the UK. So it's something that I've focused on and really niched down into in order to build up quite a good reputation and quite a good understanding of how the model works.
And in terms of your setup, I did mention about each house is newly refurbished. I think that's quite a big part, because understanding what the providers are looking for, you're able to take that requirement, go out and find a particular house and refurbish yourself. Is that right? Could you run us through the process there?
Absolutely, yeah. So as a developer, when we are looking to develop a new social housing property, it all starts from the provider. So we speak to them, we have an understanding of their areas and the locations that they're currently allowed to provide social housing in. So usually it's quite area focused, and so some providers will only take in one area, some only take in certain parts, and they have contracts with the local authorities to offer that social housing lease. So we will, as a developer, will approach a housing association and ask the typical questions of, where do you currently need properties? Do you have a high demand of tenants in certain locations? Basically, how can we help you with your undersupply of social housing? They'll give us usually they call it a green list. So they'll say, we've got this area's on the green list and we need these sorts of properties in this areas in order to really help with our demand. And from there, that gives us an understanding of how we can go out to the market and find these properties to be able to then obviously suit what the provider's looking for. We will then obviously source the property and then we'll go through the building works and the renovation that's required in order to get it up to social housing standards. They can be quite what's the word? Not tricky to deal with, but they can be they can be quite picky with how their standards look. So they typically have very stringent fire and health and safety rules. So they'll look for properties to be fully smoke alarmed, with interlinked smoke alarms and backups to be able to obviously look after the tenants. They have full emergency lighting kits. Everything's got to be obviously signed off by fully qualified electricians and gas engineers. They look for new boilers. They look for full roof repairs. So it is quite a stringent refurb that we go through in order to get it to social housing standards. But most properties are the same. They like to keep them in a very similar condition to keep their maintenance much simpler. But in order for us to do that, we have to have a good understanding of the provider. Usually they give us their property specification guidelines and we're able to go out and source properties that we can then refurb into their criteria and get them up and running as soon as possible.
Sure. So we've got a couple of questions that have come in, and I think it would probably be useful for most people to listen
yeah, we've
to.
got a few come in. So first one that's coming is what are the gross returns? Which I think we've covered off a little bit, but if you just give us a few examples. I know you mentioned it's 7% minimum, but if you just give us a few more examples of what the gross returns are.
So I think it would probably be useful just showing the portfolio of units that we have available at the minute. Now, the gross will simply be the net. If we take the last unit in Blackburn, which is £206,000, this is based on a 7-year fixed contract. And in terms of the gross income, you are looking at £15,020, which essentially would generate a 7.29 gross to net return. So there is literally no leakage in this product. And Nathan, I'm not sure if you want to add anything on the gross to net side of it.
Yeah, so like Reece mentioned there's no leakage whatsoever between gross and net. That's due to there being very minimal running cost for social housing. The providers take on the majority of the upper running costs for that property. So they'll pay the gas bills themselves, they'll pay the electric bills and the utility bills of the property, including council tax as well. So there's no bills coming off the property every month like a typical private AST property. There's also free management included from the providers, so there's no letting fees. They give a full management service. Every provider legally has to have an in-house management service, or they use a care provider in order to do that. But that gives us as an investor to be the confidence that we're getting a full management service free of charge, and there's no real outgoings. There's no real outgoings from that product that a typical AST would have. So the gross would be exactly the same as the net usually.
Thanks for that. That's great. We've had a few questions about on the same subject. It's about the exit plan. After your 5 years lease is up, what are the options? How often are these things renewed? If you want to sell, what are your options? Do you need to sell it back to another investor for social housing, or can you convert that back to just a standalone freehold house and sell it on the open market? Just what are your options? And tagged on to that, what are the capital appreciation projections for this kind of property?
So there are multiple exit plans, and we can cover through those. So typically the leases are renewed. So depending on the provider that we work with, they usually have contracts with the local authority to give social housing in the area for 10 years. But legally, they can only sign a 5 + 5 year contract, so that they can renew and they can obviously relook at their stock levels. And usually we get increased rent returns there as well when the property is renewed. So I've been in social housing now for about 6 years total, and I've never really seen anything that's not been renewed with the provider, because we're refurbing properties and we're giving them such a high quality product that it's so much easier for them to work with us rather than typical landlords that just offer them properties. So because we're in such a fresh state and we obviously have good relationships with the providers, usually properties are renewed. Obviously it's not fully guaranteed, but it can be, like I said, I've never been in a situation where we've had properties that are given back to us. So usually they are renewed. As a good plan B, we can go to the open market, and usually we do get higher rent rates from doing that. But obviously with that it incurs the cost that I mentioned before of utility bills and management services and whatnot. So it usually works out at a slightly lesser yield than what the social housing can give, because on the net yield, rather than the gross, the net yield is a lot less because we've got those running costs to take into account. But we can, with the areas that we're working in, we can put them on a private market. They will rent usually very well. There is a very strong demand in these northern areas for just typical private ASTs. And like I said, the property's up to good standards. If it's already been with a housing association and a care provider, it's got to be in a good condition in order to go out and attract those tenants that are, professional or private tenants or ASTs. And then, there is definitely an exit plan of resale. So during the lease, the investor can sell, but the lease can't be broken from the investor. So they can sell to a new investor that's willing to keep the lease, but they can't just put it on the open market during the lease being underway. If it came to it at the end of the 5 years and the owner thought, I want to cash out, I want to sell this property and move on, then they can. Obviously, they can go ahead and take the property back in condition. It will be in a well-maintained condition as well, because the provider obviously have a maintenance team throughout that cover those damages and maintenance. So they can pull it back out and put it back onto the market as a typical exit.
Excellent, thank you. One other one, obviously these they're quite long contracts, as I can see. They're up to 7 years on some of the ones you're posting there. Is the income fixed for the full duration, or do we have any kind of index linking to see that increasing over time?
Yeah, so it really depends on the provider that we're working with. Some providers are CPI linked, so they will go, the rents will increase per annum with CPI, with the Consumer Price Index. Usually we see that between 2% and 4% per annum. And then if at the end of that original lease, on the initial lease, then usually the LHA rates have changed in the area. So then we will be able to go onto the new LHA rate, which is over time has typically proven that it has increased over that 5 years. So yes, the yields will definitely be increased. Some providers aren't CPI linked, so we have to be obviously picky if an investor's looking for that. But usually they are increased, yeah.
Excellent. And just one other question just come in right now. How frequently is this rental paid? Is it a rent, annual rent, monthly, quarterly?
Yes, so it's paid monthly to the investor directly from the housing association. So the housing association will have a contract with the local authority. They'll draw down housing benefit into the provider, and then that gets paid directly to the investor every month. So and there's penalties if the provider doesn't pay as well. So it is very well assured.
Okay. I think what's worth adding on that, in terms of the UK, they budgeted last year £8.2 billion in order to house social housing. So that essentially is your tenant. You are looking at the government with that amount of funding, as opposed to looking at what I've historically been comfortable with, and that's private rental market. If you have a 1 month void period, your net position as an ROI has significantly reduced. So if you are looking for income and to look at diversifying your portfolio, even having this net position, you can really kind of work your ROI for that length of the lease.
Okay, so a couple of slightly more technical questions coming in. Well, the first one that I know we can cover off quite easily is, are mortgages available for this kind of property? And I know the answer is no, it must be a cash purchase for a number of reasons. What is the tax on the rental income? And what if the purchaser is a non-UK resident? Yes, there will be tax payable on your rental income. In the UK, even if you're non-resident, then your income that is raised there is taxable. So it would be taxable in the UK. Iris, I know you asked the question, you're in Malaysia, it wouldn't be double taxed because Malaysia and the UK have a double taxation agreement, so you'd only be taxed in the UK on that income.
Yeah, and I think it's worth mentioning that because we are really focusing here around yield, just looking at your physical income in the UK, it might be relevant to look at setting up limited companies to make that more tax efficient. But if you are a British or an EU passport holder, you will have, again, kind of your income tax relief. So you'll have up to £14,750 of tax-free income.
Yeah, absolutely. And you know, if this is something that really does appeal to you, you really should speak to your Holborn wealth manager, because we can structure these inside limited companies, which will make it even more tax efficient. But that's probably a different conversation for a different day. So please speak to your Holborn wealth manager. I think we've nearly gone through most of the questions here. There's one more question saying, will there be agents fees if we decide to sell the property? There probably would be. We are not estate agents, so yes, you'd be selling it on the open market via an estate agent, so you'd be paying whatever the going rate was. I think that's about it for all the questions, unless anyone's got anything else they want to quickly type in that we've not covered off yet.
I think there's one there about offshore accounts. There's one that's saying,
oh yes, sorry, I've not seen that one. Can the income be paid into an offshore account, or does it have to go into a bank in the UK?
So the providers typically like to work with UK bank accounts, just because obviously it's moving from the government, it has to go through the housing provider. Typically they do prefer UK bank accounts. We've seen some that will provide overseas, but it generally is a requirement for them for the owner to have a UK bank account, just to keep everything a lot simpler for them.
I think there was one more question. Who are the typical occupiers of these houses? I think this is probably a good question for you, Nathan, in terms of the areas and locations that we're looking at, which would all depend on the actual provider. But yeah, could you just give a bit of an overview on that?
Absolutely, yeah. So on paper, on the lease, the housing association is your tenant. So between your contract is directly with the housing association, and then they have the ability to then sublet onto the actual tenant that lives in the property. That's where the guarantees come from. So us having the lease directly with the provider means that they can guarantee that they can assure the rent, and they can give the damage covers and the utilities paid. The actual people that will be living in the property depends on the provider. So each provider works with different sorts of people. We've had it before where it's been nurses, and we've had people that have been come up, like business owners that have come up on hard times, and they've, maybe the business has gone bankrupt and they've had to, sell the house or been able to move into one of these social housing properties. Some have asylum seeker contracts, and those are the typical people that are living in the properties that are that we're looking at here. There's a lot of different types of people fleeing domestic abuse. There are young families. It's quite a range that can live in the properties.
I think what's also worth mentioning, because some of the purchase prices are kind of sub £100,000 and looking at a lower income, if you were to physically buy this as a cash investment or simply looking to offer it for the private rental market, again, like you mentioned, having the provider as your single tenant paying your income, covering the damage costs is huge. If, for instance, there is a window smashed or a door broken, whatever that might be, again, it's a real big point that the housing provider would be liable for that. And am I correct in saying that the checks would be every couple of weeks to make sure that everything is intact? Do you want to just cover that off in a bit more detail in terms of their routine and protection for clients, Nathan?
Absolutely, yeah. So like I mentioned earlier, each housing association has their own tenancy management service. With this, they usually check the properties at least every 2 weeks to be able to go around, check the tenants are okay, make sure everyone's happy in the property, and as well check the property for damages so that then they can report to the maintenance team and get anything fixed that is needed to be done. Examples being, we've had tenants that have broken fire doors before, we've had tenants that have smashed windows, and with that, the provider has just come in the next day and fixed it fully free of charge to the investor. So it is a very strong damage waiver. It is very good. I've seen quite a lot of different ones that have been fixed. And in terms of the actual management, like I said, they do view the property every couple of weeks just to make sure everything's fine. They have a full lettings team within the housing association that manage the tenants and make sure obviously all their needs are met.
I think there are two more questions that have come in. So one was any properties in the south Surrey. I'm not familiar with the north area. So I know obviously we're working with you that we do have properties across the UK. Again, for the individual allocations that we're looking at the minute, ideally we look further to the north, simply because we're able to accumulate a higher net position. I think for investors that are looking at yield investors, to try and take the emotion out of it and simply see this as a net ROI. We can look at the likes of London, Surrey, whatever that might be, but your yield would typically be compressed. So I'm not sure if there's anything more that you would want to add on that, Nathan.
Yeah, that's it. So we're based in the north of England. We provide most of the properties up here, and as the name in the business mentioned, it is fully focused around yield. So when we sell to investors, they are typically looking for a return on investment rather than a more emotional property purchase of, where's the property? Is it in this refurb? Is it in this location? It is more of what yield can I get and what's the provider that we're working with and what's their strength on the lease. It is much more of an investment rather than obviously a property that is going to be lived in by obviously the owner. So we typically sell it based on the returns and the strength of the contract. It's something that's very difficult to get unless you have the relationships, and that's where we're able to guarantee and assure yields through that those contracts that we provide.
Excellent. And a few more coming in now. So what kind of capital appreciation are we looking at on these types of properties in these kinds of areas? I know it's not something you can say exactly what's going to happen, but are they likely to move in line with the UK property market?
So just in terms of the average UK house price growth, you're looking at an average of around about 6%. Now, this is slightly different because in terms of capital appreciation, it's really built up from demand and an emotional aspect that individuals would really want to try and pay a premium to live in a certain location. This is kind of the polar opposite. The strength of these properties on the exit would be based on the yield. Now, like Nathan mentioned, assuming we're getting a lease that would be linked to inflation, your income is going to be increased, which ultimately, if you're looking to exit that to an investor, that can be packaged in line with the yield, exactly the same as what we're looking at now. But ultimately, look, house prices are typically growing at 5 to 6% per annum. So again, I'm not sure kind of your view on the uplift on prices, Nathan, because you're actually going out, identifying these particular houses, buying them and fully refurbishing them yourself, right?
Yeah, absolutely. I mean, as a developer, we've seen it over the last probably 3 or 4 years. The prices increased. When we first started, we was able to pick up properties much cheaper than what they currently are now, which is a little bit frustrating. But we're able to, yeah, we've seen capital appreciation in these areas quite strongly in the last few years, especially towards the larger cities that we work in. So it's very tough to put an actual percentage on it and really, give a definite answer, because obviously capital appreciation can never be guaranteed, and we can never actually put it on per area. But with these properties, we have definitely seen it within a range of probably at the absolute lowest 2% to up to probably 5-6%, as we said. So it is tough to actually really to give a definite answer, but it's definitely seen it, and the market's definitely not stagnant.
Excellent, good stuff. Well, one more question. At the price we're showing here, is that a property that's coming fully furnished, ready to rent, or are we needing to put extra money in to furnish it?
So on the list that you're looking at here, that's buying the property fully up and running. So there'll be no extra costs from us as the seller. You're buying it fully furnished, and usually with the tenancy and the lease already in place. So I'm just looking at the screen there. There's a few that are already up and running. So when it says tenancy start date 2020, that's when leases have been signed last year and they're currently up and running. Where it says up on completion, that's where you're getting a brand new fresh lease that's going to be signed post renovation. So usually those properties are having works done, or we're getting the lease signed, and upon completion to the purchaser, you get a brand new fresh lease that runs for that entire duration, rather than buying something that's obviously 6 months in or 3 months in. However, so yeah, that's the price that's included to fully get that unit up and running and start making the rental income.
Excellent, good stuff. I think we've just about covered all the questions that have come in, unless I'm missing one, which I don't think I am. So unless anyone can think of anything else that we think we should have answered that's not come in, or if anyone's got a burning question they want to type in before we sign off for the day, I think we're about done.
I think for any more particular questions, as you mentioned, Matt, by all means, please contact your Holborn advisor. But Nathan and I are here to help on any individual meetings via Zoom to go into any particular questions. But again, we're here to support all the way through any questions that might have been forgotten through this webinar.
Yeah, I would suggest that if anyone is particularly interested in looking, at a property, looking at how the cash flow will work, hearing about how it would look to structure that inside a limited company and the tax benefits, please speak to the Holborn advisor that invited you. They will sit down, talk you through it, get these guys on a one-to-one call, and we can talk for that in great detail. So I think we'll close that for today. Thank you, everyone that's attended. Thank you for the guys that have spoken, and it was such a great presentation. Hope you all found that useful. And as I said, just get in touch with your advisor if you want to speak in any further detail. Thank you all. Thank you, Reece. Thank you, Nathan.
Thanks, Matt. Thanks, Nathan.
Thanks, guys.
Cheers.
All the best, everybody. Thank you once again.
Thank you.